Let's talk about Salesforce. Salesforce on Thursday had one of its worst days since 2008. Numbers for the quarter weren't incredible and guidance was lowered, so definitely not something you want to see happen, especially not in the current macroeconomic environment and especially not during this earnings season. We've seen a small miss and your stock can get punished quite hard. In this case, Salesforce was down close to 20% on Thursday, meaning year to date it's down 17%, and in the last 3 months it's down closer to 30%. If you look at the stock's performance in the last 3 years, it's down 8.32%, but in the last 5 years the stock is still up 42%. Now overall, of course, in the last 5 years the business has become bigger and bigger, so there is that. But of course, now we are in a completely different environment. We're in an environment where AI might be a huge tailwind for one company, but a huge headwind for the other. In this case, with regards to Salesforce, right now sentiment is that, well, they're behind with regards to AI. AI is going to be a headwind for the company right now and not a tailwind. In my opinion, Salesforce is one of the, well, it's not in my opinion, but Salesforce is one of the biggest software companies on the planet. Salesforce, in my opinion, is not going to disappear in the short run and maybe not in the long run. I mean, who knows what happens in the next 20 years or so. But I find it very, very hard to believe that Salesforce will not turn this around. They've had struggles in the past and they've managed to turn it around and become a bigger and more profitable company. So I still have the same opinion. Of course, we're going to have a look at the numbers in just a second. But before that, if you enjoyed this type of videos, leave it a thumbs up, subscribe if not, we really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So first of all, I want to show you a major overview here from Brad Freeman, Stock Market Nerd on X, one of the best accounts you can follow for everything stocks related. So, results for this quarter, barely missed revenue estimates and barely missed guide as well. But they did miss current RPO, they did beat GAAP earnings per share, and they also beat EPS estimates. But the problem here is annual guidance. They reiterated annual revenue and EBIT guides, which both missed by 0.4%, but they slightly lowered annual subscription revenue guide, they lowered annual GAAP EBIT margin, and they slightly lowered annual GAAP EPS as well. But that met estimates. But then again, when you see lowering, it's a bad thing right now. Well, right now, I think every time you see guidance being lowered, it's not a good sign. But they did raise annual EPS guide by 18 cents, which beat consensus numbers by 11 cents. This company is certainly becoming more and more profitable. And so, right now, the current average analyst price target sits 56% higher than the price we're at today. So, most analysts, while some have had their stock price target lowered and maybe rating downgrade, overall, on average, it's still much higher than the price we're at today. If we're looking at what the analysts are expecting for the next coming fiscal years, we can see that sales growth will be on average at 10% or so. But the company, as I said, is becoming more and more profitable. So EPS for fiscal year 2025 expected to grow 18.6% year over year, followed by 14% growth in 2026, followed by a reacceleration, actually 18% growth year over year in fiscal year 2027. If we look at shares outstanding and free cash flow per share has grown tremendously throughout the years. Shares outstanding have increased as well throughout the years. Of course, this is a company that has been acquiring quite a lot of other companies. And of course, stock-based compensation is included in all of that. But more recently, they are buying back more shares. They also issued a dividend. They have a dividend yield of 0.74%. And if we look at forward PE, EV to EBITDA, price to sales, price to free cash flow, price earnings to growth, it is now, I wouldn't say for all much lower, but for most of it, it's much lower than the 5-year mean. So yes, you could say that the company is now cheaper than ever before, but there might also be a reason for that. And the reason is, well, growth. Growth has slowed down tremendously. So Salesforce sees first ever single-digit sales growth. So the stock is cheaper, but growth is slower. So it makes sense. But again, how much cheaper should it be despite it becoming more and more profitable? Because if we look at the numbers and the comments as well, we'll start with the comments first. Our profitable growth trajectory continues to drive strong cash flow generation. Q1 operating cash flow was $6.25 billion, up 39% year over year. Q1 free cash flow was $6.1 billion, up 43% year over year. Those are tremendous numbers. We are at the beginning of a massive opportunity for our customers to connect with their customers in a whole new way with AI. As the world's #1 AI CRM, of course, the AI part here needs to be added now, we're incredibly well positioned to help companies realize the promise of AI over the next decade. We delivered another quarter of disciplined, profitable growth with GAAP operating margin of 18.7%, up 1,370 basis points year over year, and non-GAAP operating margin of 32.1%, that was up 450 basis points year over year. We've also made significant progress on our capital return program, returning more than $14 billion to shareholders since inception, including the payout of our first ever quarterly dividend in Q1. Like I said, maybe growth is slowing down, sales growth is slowing down, stock is now as cheap as it has ever been, but in my opinion, the company is becoming more and more profitable, maybe more profitable than ever before. So this quarter revenue increased 11% year over year to reach $9.13 billion. First quarter GAAP operating margin of 18.7%, as we've seen before. Current remaining performance obligations of $26.4 billion. That was only up 10% year over year. With regards to operating cash flow and free cash flow, we've seen that as well. These numbers are, when you grow free cash flow 43% year over year, you're probably doing something good. And in this case, they also returned $2.2 billion in the form of share repurchases and $0.4 billion in dividend payments to stockholders. And of course, as this company generates more and more free cash flow, if the stock stays cheap, that will allow them to retire more and more shares, returning even more value to shareholders. And I do think that this will continue because if you look at total cost of revenues, basically flat year over year. If you look at total operating expenses, that's actually down year over year, while revenues are up 11%. So they're definitely doing something good. Then with regards to guidance, and this was basically where it went wrong. So Q2 guidance to be between $9.2 to $9.25 billion. Slight miss there, I believe. The market was looking for $9.35 billion. That's only growing 7 to 8% year over year. With regards to full year guidance, that is expected to grow between 8 to 9% year over year to come closer to $38 billion. And so if we look at the stock right now, $217.70 after hours, RSI is low, but still not oversold. This is on the weekly. I think if we switch to the daily for a second here, yes, for the daily, we are oversold right now. But switching back to the weekly here, I would say, if you are someone that would like to open a position in Salesforce, you'll be looking for better prices. I would say start dollar cost averaging because maybe we could see the $200 mark, as that has been a rebound area that we've seen back in October of 2023. So I think those areas between now and $200, those areas could be areas where things could get interesting. Then of course, if it breaks down below, maybe have a stop loss. If it breaks down below, well, then you're truly in no man's land. But overall, to conclude, Salesforce, like I said, still one of the better companies out there. I don't think that one quarter changes the whole thesis here. One quarter where suddenly you see people say, oh, Salesforce is dead, it's dying, the business is done. We've seen this already with a couple of companies, right? We've seen this with Google, with Amazon, well, Alphabet, Amazon, with Meta, with Netflix. How many more times are we going to see this? It's true that some companies, it's true that these types of quarters, it's a sign of worse things to come. But usually those types of companies are not named Salesforce, Netflix, Alphabet, Amazon, or Meta, right? We've seen the rebound story of all of those companies. And I still think that a year, 2 years from now, we're going to look back and look at Salesforce and say, $217, $200, that quarter, that was a joke and a good opportunity to add. Now, me personally, I don't own any shares in Salesforce. It is becoming quite appealing, but in my opinion, I've got enough stocks in my portfolio. So this one is just one I'm watching right now. So that's about it for me in this video. Of course, do share your thoughts down in the comment section below. If you enjoy this type of video, give it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.